Hello traders, Dan here. A quick little update. I've got a couple emails of why we sold covered calls on our directional long yesterday on the spiders and Qs. So I just put this together real quick. Let's jump right on into it. So here's the pattern. I'm not showing you the daily, but here's the hourly. As we've been talking about, Greg's done an excellent job talking about the potential reversal, breakdown failure in the broader market indices. And this is just an hourly chart of both the spiders on the left, the QQQs on the right. So yesterday, in the Master Trader advisory letter, we just gave an outright buy the ETF. So on the left here, the spiders on the breakout. On the right is the QQQ, a directional bullish trade, no options involved. So let's go to the next slide here. So today, the market gapped up. Spiders on the left, Qs on the right again, but a 5-minute chart. So it had a nice gap up, and on an hourly chart, they were actually oversold. It could have been a gap and crap. And because the volatility is so high, we were able to sell some out-of-the-money calls to lower our cost basis, but it was just for, well, it's either, 1 or 2 days of risk. It's 1 day to expiration, meaning we sold it Thursday and it expires on Friday, but we did it in the morning, so I kind of think of it as 2 days to expiration. And so we used the charts, we waited the morning here, and then when it broke down in the morning from the gap and crap on the hourly, we recommended you sell the out-of-the-money calls. So just roughly here are the stocks at 265 and change. We still went up to the 267 calls and got 93 cents a share for expiring tomorrow. So that immediately lowers our cost basis by 93 cents a share. And as long as it closes by tomorrow under $267 short call strike price, we've improved our cost basis 93 cents a share. Now, we only did 1 day risk because we're still bullish on the overall pattern. That's why we didn't do a 8-day trade. So let's jump over here to the QQQs. Similar rationale. It broke the pre-morning consolidation at the market open. And so this one we sold a 163 call, which is way the heck above here. And we took in another 45 cents a share, lowering our cost basis. And you can see this is nowhere near 163 as of the market close. This one's nowhere near 267. But even if we like the trade to go higher, we don't need to let them take our stock. We could close it and just close it at a gain at this point in time because of time decay, or we could roll it higher to next week's at a higher strike price for more time premium. So that's it. That was the quick little lesson of why we did that, and it worked out phenomenally well. And that's why we love selling covered calls on patterns that have stalled or breaking down, or just short-term credit to lower cost basis. So here's we have a great covered call free ebook if you want to check it out here. Here's the link, and that will show you exactly why we do these patterns. So that's it. Have a great night and happy trading. See you tomorrow.